Hey everyone, and welcome. So, let's talk about investing. I know, it can sound super complicated, maybe even a little scary. But trust me, by the end of this, we're going to break it all down. We're talking from zero to feeling confident enough to make your very first investment. Ready? Let's dive in.
Okay, just let this sink in for a second. What if your money could actually make more money than you do? I mean, think about it. We're all taught the same thing, right? Trade your time for a paycheck. But investing, it completely flips that on its head. It's about your money working for you 24/7, while you're sleeping, while you're out with friends, you name it. And that simple shift in thinking, that's everything.
So you might be thinking, okay, sounds good, but why should I really care? What's the secret sauce here? Well, it all boils down to one incredibly powerful idea, maybe the most powerful force in all of finance, actually. And it's called the compounding effect.
Yeah, that's right. Einstein himself supposedly called it the eighth wonder of the world. And you know what the best part is? Unlike that calculus class you might have slept through, this is math you can actually use to literally change your life. Think of it as the engine, the powerhouse that's going to make your investments grow.
So what is this magic, you ask? All right, the simplest way to think about it is this. It's your money making babies. And then those babies grow up and have their own babies. See, you earn a return, you put that return right back in, and now you're earning money on your original investment plus on the earnings themselves. It's a snowball effect, and all it needs are two things, two really simple things. You have to reinvest those earnings, and you have to give it time. That's it. And the more time you give it, oh man, the more powerful this thing gets.
Okay, to really see how this works in the real world, let's look at a quick story. Let's meet two people, Pam and Sam. First, we've got Pam. She's 25 years old, she scrapes together $15,000 and makes a one-time investment. That's it, puts it in an account and just lets it do its thing.
Now here comes her friend Sam. He invests the exact same amount, 15 grand, and he gets the exact same 5.5% return every year. Everything is identical, except for one tiny little detail. Sam waits. He waits 10 years and doesn't start until he's 35. And the difference this makes, it's just incredible. Fast forward to age 50. Pam's account, it's grown to over $57,000. Sam's, it's sitting at about $33,500. That's a difference of over 23 grand. And Pam didn't do anything extra. She just started earlier. That 10-year head start, that extra time for the magic of compounding to work, made all the difference. This is the main takeaway here. Time is your single greatest asset when it comes to investing. Period.
Okay, so hopefully you're sold on the why. You get it, compounding is powerful. But that leads to the next big question, right? What on earth do I actually buy? Let's break down the basic building blocks.
All right, so at the highest level, you've pretty much got two main flavors, stocks and bonds. When you buy a stock, sometimes called an equity, you're literally buying a tiny piece of a company. You become a part owner. So if the company does well, you do well. That means higher potential for growth, but yeah, it's also riskier, more up and down. Now, a bond is totally different. With a bond, you're not an owner, you're the lender. You're basically loaning money to a company or even the government, and they promise to pay you back with interest. It's a lot more stable and predictable, but because it's safer, the returns are usually lower.
Now, the good news is you don't have to go out and try to pick the next big winning stock or bond all by yourself. You can actually buy big collections of them all at once. Things like mutual funds or ETFs. They basically pool a bunch of people's money together to buy hundreds or even thousands of different investments. And hey, if you like the idea of real estate but can't afford to buy an entire apartment building, you can look into something called a REIT. It's a way to invest in a portfolio of properties.
Okay, we've covered the why and the what. Now for the part that stops so many people, the how. How do you actually take that first step? Let's get practical.
First things first, you need a place to buy and hold your investments. This is called a brokerage account. Just think of it like a special bank account, but instead of just holding cash, it holds your stocks and bonds. So how do you pick one? Well, here's a super helpful checklist. You want to look for things like fees. Are there sneaky hidden costs? Do they have a minimum amount you need to start? Because you want one where you can start small. A really cool feature is fractional shares, which lets you buy just a little slice of a big expensive stock. The bottom line is you want something that's cheap, easy to use on your phone, and helps you learn along the way.
All right, so once your account is open, it's really important to get this next part right. Investing isn't about gambling or chasing some hot stock tip you heard from your cousin. Real successful investing is about being smart. And that starts with understanding risk and knowing the #1 strategy to manage it, which is diversification.
So check this out. Not all risk is created equal. There are really two main types. The first is what we call unsystematic risk. This is the stuff that affects just one company or one industry, like maybe a specific car company has a major recall. The good news? You can protect yourself from this. But then there's systematic risk. This is the big stuff that hits the entire market, like a recession or a pandemic. You can't really avoid this one, but you can definitely prepare for it.
So how do we deal with that first kind of risk, the company-specific kind? Well, you've heard this a million times before, and it's because it's absolutely true. It's the whole idea behind diversification. If you spread your money out across a bunch of different investments, and one of them tanks, it's not a catastrophe. It won't drag your whole portfolio down with it.
And this is what that actually looks like. A diversified portfolio isn't just one thing. It's a mix, right? You've got some stocks in there for that long-term growth. You've got some bonds to provide a little stability and calm things down when the market gets choppy. And you might even have some cash on the side, ready to jump on a good opportunity. Now, the perfect mix for you, that's going to depend on your own goals and, how much risk you can stomach. Okay, let's switch gears to something that's maybe the most overlooked part of investing. It's something that trips up even the pros. Because a lot of the time, your biggest enemy isn't a bad market. It's the person staring back at you in the mirror. It's your own brain. This quote from Peter Lynch, who's like a legend in the investing world, just nails it. He's basically saying that to be a good investor, you don't need a super high IQ. What you really need is a strong stomach. It's all about managing your emotions. Because those knee-jerk gut reactions you have when the market goes crazy, they can absolutely wreck your returns if you let them. Let's talk about the first big brain trap. It's called loss aversion, and we're all wired for this. Think about it. How would you feel if you lost a $100 bill? Now, how would you feel if you found a $100 bill? For most of us, the pain of losing it is way, way stronger than the joy of finding it. And that emotional weirdness makes us do really irrational things with our money just to avoid feeling that pain of a loss. Here's a perfect example. Let's say you own a stock and it's down, say, 20%. Everything you read, all the analysis says it's probably not a great company anymore. The logical thing to do is sell, but you just can't. You don't want to make that loss real. So you hang on, just hoping it'll come back, and in the meantime, you're missing out on putting that money into something much better. Yep, that's loss aversion at work. Okay, brain trap number 2, confirmation bias. And oh boy, we are all guilty of this one. It's our natural tendency to want to be right. So we go looking for information that proves we're right, and we conveniently ignore or dismiss anything that suggests we might be wrong. And you can see how this would be super dangerous in investing, right? You buy a stock you're excited about. You'll read every positive news story. You'll watch every interview with the CEO praising the company. But that one really well-researched article that points out a huge new competitor on the horizon, you just scroll right past it. Just knowing that your brain does this is the most important step to fighting it. So, look, we've covered a lot. We've talked about risk and diversification and all these little brain traps, but you know what the single biggest risk of all is? It's not the market crashing. It's doing nothing. It's letting all this stuff overwhelm you and just not starting. Remember that compounding magic? It has zero power if you never put the first dollar in. So the real question is, after hearing all this, what's your first move going to be?